Welcome to our deep dive into the world of relative valuation. For venture capitalists and angel investors, understanding how to value a company against its industry peers is the cornerstone of making informed investment decisions. Unlike absolute valuation models that rely on long-term cash flow projections, relative valuation uses multiples to compare a company's market value to its financial fundamentals. Today, we will explore the three pillars of this approach: the PE, PS, and PB ratios. By mastering these tools, you can quickly screen high-growth opportunities and identify whether a company is undervalued or overhyped. Let's start by defining the framework of benchmarking and why these three core multiples, PE, PS, and PB, are essential for your screening process. This comparative approach allows us to see how the market prices a dollar of earnings, revenue, or assets across different firms in the same sector. The price-to-earnings, or PE ratio, is perhaps the most widely recognized metric in finance. It calculates the relationship between a company's stock price and its earnings per share. In simple terms, it tells you how much investors are willing to pay for every dollar of profit the company generates. We typically look at two types: trailing PE, which uses the last 12 months of earnings, and forward PE, which uses projected future earnings. A high PE often suggests that investors expect high growth in the future, but it can also indicate a stock is overvalued. Conversely, a low PE might signal a bargain or a company in decline. For mature companies with steady net income, the PE ratio is your primary profitability barometer. It helps distinguish between companies that are actually making money versus those that are just burning through capital. When evaluating high-growth startups that are not yet profitable, the PE ratio becomes useless. This is where the price-to-sales, or PS ratio, shines. By dividing market capitalization by total revenue, this metric allows investors to value a company based on its top-line performance rather than net income. This is especially critical for early-stage tech companies that are reinvesting every cent into expansion. A low PS ratio relative to the industry average might indicate an undervalued opportunity with significant revenue growth potential. However, it is important to remember that the PS ratio does not account for the cost of debt or the path to profitability. It is a powerful tool for valuing revenue growth in sectors like SaaS or e-commerce, where capturing market share is often prioritized over immediate profit. The price-to-book, or PB ratio, compares a firm's market value to its book value, which is essentially the net asset value found on the balance sheet. For capital-intensive industries like manufacturing or for financial institutions, the PB ratio provides a safety net perspective. A PB ratio below 1.0 often suggests that a company is trading for less than the value of its physical assets, which could indicate a deep value play or significant underlying problems. For high-growth tech firms, the PB ratio is often less relevant because their most valuable assets, like intellectual property and brand equity, are not captured on the balance sheet. However, when evaluating asset-heavy industries or distressed assets, the PB ratio is your best friend for assessing the intrinsic value of the company's tangible resources. Not all ratios are created equal for every deal. To master relative valuation, you must choose the right tool for the specific sector and stage of the company. A multi-metric approach is always superior to relying on a single number. For a mature consumer goods company, you would lead with the PE ratio. For a pre-profit AI startup, the PS ratio is your primary guide. For a regional bank or a shipping company, the PB ratio takes center stage. By benchmarking these ratios against a carefully selected peer group, you can see where a target company sits on the spectrum of value. If a startup has a PS of 10 while its peers are at 5, you need to justify that premium. Is their technology truly twice as good, or is the valuation inflated? This comparative analysis is what separates professional VCs from speculators. One of the biggest risks in relative valuation is falling into a value trap. This happens when a company looks cheap based on a low PE or PB ratio, but is actually a poor investment due to fundamental flaws like high debt, declining market share, or technological obsolescence. You must always look behind the numbers. A low PS ratio might look attractive, but if the company's margins are razor-thin and they are losing money on every sale, that growth is unsustainable. Beware of industry outliers. If one company's multiples are significantly lower than its peers, there is usually a reason. Always verify the quality of earnings and the health of the balance sheet before concluding that a low multiple represents an undervalued gem. Understanding the value trap and avoiding common pitfalls is what protects your capital in volatile markets. In the world of venture capital and angel investing, we are often looking for the next unicorn. In these scenarios, traditional PE ratios are rarely applicable. Instead, we focus heavily on the PS ratio and sector-specific metrics like forward revenue multiples. For a SaaS company, we might look at a PS ratio of 15x as standard, whereas a hardware startup might only command 3x. When pitching to partners or evaluating a term sheet, you must be able to explain why your target's multiple is justified based on their growth rate and total addressable market. A high-growth sector demands a different lens. By applying these metrics correctly, you can argue for a higher valuation based on the company's trajectory relative to recent exits in the same space. This is how you build a data-driven case for high-growth opportunities. To conclude, mastering relative valuation is about more than just memorizing formulas. It is about building a holistic framework for investment analysis. By consistently using the PE, PS, and PB ratios, you develop a sense of what fair value looks like in different market conditions. Remember to always compare companies within the same industry. Use a multi-metric approach to verify your findings, and stay vigilant for value traps. Whether you are an angel investor looking at your first seed round or a seasoned VC partner, these comparative tools provide the quantitative foundation needed to back up your qualitative intuition. Start applying these ratios to your current pipeline today to refine your selection process and maximize your portfolio's potential. Thank you for joining this guide to mastering relative valuation and strategic investment decisions.